Okay, hello to everyone. This is Dan I with your first quarter update. Thanks for taking some time to listen in. And as always, I'll mention up front if there are any questions or topics anyone would like to talk about in more detail, please feel free to reach out to us. Okay, I know this is everyone's favorite part. Let me just go ahead and get through our disclaimer information here before we get started. So this webcast is for informational purposes only and does not constitute a complete representation of Roof Advisory Group services. The information presented on this webcast should not be considered personal financial advice. Any use of information from this webcast for personal use is at your own risk. Information throughout this presentation is gathered from sources Roof Advisory Group believes to be reliable, but we do not warrant or guarantee the timeliness or accuracy of this information. Our discussion today will consist of forward-looking statements. Actual results or trends could differ materially from our outlook. Roof Advisory Group assumes no obligation to update any forward-looking statements or information which speaks as of their respective dates. Okay, great. Let's go ahead and take a look at today's agenda. And as usual, we'll get started with a market review. I probably don't need to, remind anyone on the call that we closed out 2018 with the worst December for equity markets since the Great Depression. Obviously, a much different environment in the first quarter. U.S. stocks really led the charge with the S&P 500 index over 13%. But a strong, broad-based rebound across global and international stock markets as well. Also, a very strong quarter for bonds, with the Barclays Aggregate Index up almost 3%, which we show on the slide here in green. That solid bond market performance was driven by a significant decline in interest rates. And with such a powerful stock market rally, it's unusual to see such a forceful decline in interest rates at the same time. So the stock market and the bond market seem to be telling much different stories. Equity investors seem to be anticipating an improvement in the economic environment and a better outlook for corporate earnings growth, while bond investors seem to be expecting a further slowdown. And we'll talk about that dynamic in a bit. And here's a quick look at our summary table, with those first quarter results for each index we just reviewed. Okay, we have a few more slides than normal to cover on the economy, but I'll work through them quickly and maybe just give some summary thoughts on our views up front. Economic growth is slowing compared to the bump that we got in 2018, which was driven by the tax cuts and a number of other factors. That slowdown has been very well anticipated, very well it's been expected, and it looks like our economy is downshifting back to the kind of average growth levels that we've experienced during the 10 years of the current economic expansion, which is around the 2% GDP growth level. So not a terrible outcome, and certainly one that we've experienced for a long time. The risk to that outlook is centered around international economies weakening further and having a more pronounced negative impact on the U.S. So with that said, let's roll through these slides. Here we show the status of the global services and manufacturing sectors, which is the chart on the left. Both have slowed, but more pronounced decline in the manufacturing sectors of the global economy, which you can see in the gray line on the chart. And we think that slowdown in the manufacturing sectors is more impacted by trade tensions, which we'll talk about. And on the right, global GDP growth rates, which as of the most recent data, have slowed down to about 2.6% growth, which is slightly below the averages of the past 15 years. We also want to cover, why is growth slowing? What's having the largest impact? And the chart on the left shows, global trade volumes, trade between different countries over the past 20 plus years. And we can see, a pretty noticeable drop off there. So global trade tensions or frictions, our trade skirmish or battle with China, is having a negative impact there. And on the right, we show China's GDP growth rates over the last 10 years, which is still, very high compared to most economies, but, has slowed dramatically since, let's say, 2010. China, is no longer a developing country. They're the world's second largest economy with an annual GDP of around $14 trillion. So when China slows down, the rest of the world really feels it. And I'd say, the optimistic view here is that, if we do strike a meaningful trade deal with China, we would expect to see improvements in both of these categories. So we think this is a good chart that takes a look at the status of our economic expansion that began, after the financial crisis. And the fact that this is about to be the longest expansion on record at 117 months and counting has gotten a lot of attention, mostly centered around the question of, it's gone on for so long, when's it going to end? And that's, certainly a very fair question. Expansions can't go on forever. But I think the chart on the right is pretty important too. And this shows the cumulative GDP growth for each one of these expansions. So really just add up each year of GDP growth for the entire term or the entire length of these specific time periods or each of these individual expansions. And what we can see here on the chart is that this has been, by far the shallowest recovery. And, why is that important? We think it's important because, what tends to kill expansions is excesses and inflation. Excesses in terms of consumer debt or leverage, excesses in terms of investor optimism or corporate spending, etc. And with such a shallow recovery, it's more difficult for these excesses to occur or to build up. And we'll talk about the other, inflation theme in a minute as well. And not too much to talk about here. I won't spend a lot of time. This just shows the average, GDP growth levels for the U.S. economy over the past 5 decades. And you can see, we've averaged 2% growth over the last 10 years. So it's certainly not as if our economy is downshifting to unprecedentedly low growth rates. That's been the average for the last 10 years. And finally, a quick look at inflation. As I mentioned earlier, inflation, has led to the end of expansions. So here's a look at, kind of 2 different measures of inflation going all the way back to 1970. The long-term average has been 4%. Right now we're hovering around 1.5 or 2% inflation. We've been in that low range for a long period of time, and we struggle to see anything on the near-term horizon that's really going to push inflation measurably higher. Okay, we talked about the Fed pivot or U-turn in our quarterly market view summary, and just wanted to maybe explain that topic in a bit more detail. The Federal Reserve moved from a forecast of 4 interest rate hikes for 2019 to 0 hikes for 19 in the span of about 4 or 5 months. That's a pretty dramatic pivot in a short period of time. And what we're showing on the chart here is to the right, the 9 interest rate hikes that the Fed has already implemented since late 2015. And then the little, kind of wishbone looking divide shows the difference between the Federal Reserve's future interest rate projections at the top, and then what the fixed income markets are actually anticipating. The Fed Reserve, their projections show, as I mentioned, 0 hikes for this year, and then maybe one more for 2020. While the fixed income markets, which are pretty smart, are saying that the Fed has already enacted their last hike of this cycle, and in fact expect their next move to be an interest rate cut. So just a dramatically different position than we were in October of last year. And I'd say, as we know from the 7 years of quantitative easing after the financial crisis, equity markets like low interest rates and easy money. So we think it's pretty fair to conclude that this shift from the Fed has been a major significant contributor to the equity market rebound that we've seen in the first quarter. Okay, let's talk about portfolio positioning. We ended last quarter with a pretty defensive cash position of roughly 13 to 15%. We redeployed that cash in early January as equity markets stabilized. We saw further progress with the U.S.-China trade negotiations, some encouraging economic data, and the Fed pivot that we discussed. So cash levels have been brought down to pretty minimal levels. We returned to a midpoint equity allocation, which we feel is appropriate in the current environment. We also added to core fixed income positions for income generation and as a buffer against future equity market volatility. And drilling down a bit further on the equity side, we completed our rotation away from dedicated foreign stocks in the fourth quarter of last year. So our concentration is really to large cap domestic stocks, which includes a firm tilt towards high quality, value oriented equities. And then on the fixed income side, besides that overall increase to core positions in the first quarter, no real dramatic changes in the character of our fixed income positioning. Still maintaining a fairly short duration stance or limited interest rate risks. And with yields on short-term bonds, about on par with longer-term bonds, a dynamic that we'll discuss shortly. We think it's difficult to make the case to add the long-term bonds, which carry more interest rate risk without offering higher yields. Okay, let's shift gears here and talk about performance attribution. I'd say obviously with the backdrop of a 13% advance in domestic equity markets, and also a strong contribution from the fixed income side, portfolios performed well for the quarter, and we would classify results or outcomes as in line with expectations for our level of risk exposure. But let's cover a few specific contributors and detractors. On the contributor side, that elimination of dedicated foreign stock exposure was beneficial in the first quarter as domestic stocks turned in better performance results than markets outside of the U.S. We were really pleased with the rebound in preferred stocks, as we talked about on our previous call. Preferreds were beat up in the fourth quarter sell-off, kind of unjustifiably so in our opinion. So it's nice to see that bounce back there with preferreds up about 5 to 7% for the quarter. And finally, technology stocks were the top performing equity market sector, and a sector where we have a large allocation across investment policies. So that outperformance was certainly beneficial. And on the detractor side, we would include, more defensive equity sectors such as healthcare, utilities, telecommunications sector. All very strong and respectable returns, but not ones that quite kept up with the pace of the S&P for the quarter. And also, financial stocks were also detractors, as those performance results were weighed down a bit by the decline that we saw in interest rates. So I think to summarize, an outstanding quarter, but let's certainly not make this our expectation going forward. If we were to take these quarterly results and annualize them for all of 2019, that would put the S&P up about 64% and the bond index up over 12% for the year. So never like to make short-term predictions, but that's probably not going to happen. Okay, so here are a few topics that we think are relevant and worth discussing. So the first quarter economic data that we're seeing right now is skewing towards the towards the downside. We have seen some some green shoots, but certainly not great. We think that the government shutdown is having a bit of an effect on some of the quality of the data that we're seeing. But even putting that aside, we've seen this phenomenon of the first quarter of the year being the weakest, followed by improvements as those years progress. We've seen this dynamic in 4 of the past 5 years. And to be honest, we really haven't seen a real strong, compelling explanation for why this occurs. It may be data collection issues, or it might be weather, or maybe the consumer is just kind of tapped out after the holidays. But I think the real point here is that we probably can't put a whole lot of weight behind the first quarter economic data that we're seeing right now, and the full year may not follow the same trend that we're seeing or have historically seen in different first quarter environments. Okay, so we did see at least a partial and temporary yield curve inversion in the first quarter that got a lot of attention, and justifiably so. This is something that hasn't happened in something like 11 years, and historically, yield curve inversions have been fairly reliable recession indicators. So certainly something to discuss. First, what is a yield curve inversion? And we've shown an example of that here, but it's when shorter maturity bonds, like a 3-month Treasury, pay investors a higher yield than longer term bonds, such as a 10-year Treasury bond. So the chart shows a snapshot of the yield curve at close to the end of March, and you can see kind of, to use my previous example, those 3-month Treasuries offering investors a yield of 2.46%, which is higher than the yield of 2.41% on a 10-year Treasury bond. And that's not a normal state of affairs for the fixed income markets, and intuitively it just doesn't make sense either. Generally you wouldn't lend money to someone or to a corporation at a lower rate for a longer period of time. There's just more that could go wrong as that time horizon of the loan extends. If it was a personal loan, the borrower could lose their job, they could die. Corporations, if it was a corporate loan, or if you were buying a corporation's bond, they could go bankrupt, and there's a higher probability of those events as that time period is extended. And also a greater probability that inflation rises dramatically over a long period of time. So investors should demand higher interest rates for the increased uncertainties of lending money for longer periods of time. So while this isn't normal, we think there are a number of factors to consider before concluding that this categorically means that the U.S. is heading into a recession. And some of those issues are this partial inversion only occurred for a few days. I'd say most economists would agree that an inversion would need to last for an extended period of time before it should be taken as a more meaningful signal. Other parts of the yield curve, important parts, have not inverted. Other economic indicators really don't confirm that a recession is around the corner. Extraordinarily low or even negative bond yields outside of the U.S. are putting downward pressure on our yields, especially our longer term yields, which we'll talk about in some more detail. And I think probably most importantly, if we were to look back over the past 5 economic cycles, the U.S. entered a recession 2 years on average after a yield curve inversion, and that significant lag time makes it really difficult to utilize even undisputed yield curve inversion as a really reliable term for any type of near-term economic conclusions or investment strategy decisions. Okay, just a couple more topics here, and then we'll wrap up. But want to spend a little bit more time on the Federal Reserve. They have raised interest rates a total of 9 times since the late 2015. There has been a lot of talk, I'd say especially from President Trump, that they have been too aggressive and that their actions have really impacted economic growth. And we think that this chart helps to put that, or our current interest rate hiking cycle into context. So the Fed's raised interest rates from 0% to roughly 2.4%. Over the last 5 previous hiking cycle, the Fed hiked rates up to an average of 7.5% before they stopped. So, as of now, our short-term interest rates are roughly, 1/3 of where those peaks have been historically. So, based on that information alone, it's really hard to say that the Fed's been anywhere close to aggressive, but there are important, counterpoints to that conclusion, and we'll wrap up with one of those on the next page here. And this is a comparison of U.S. bonds or interest rates compared to those of other developed international economies. And here we're just using yields from 10-year government bonds as an apples to apples comparisons. But as you can see, besides Italy, U.S. interest rates are much higher. And I think that lends itself to just a couple of points. And I think first is probably what's on everybody's mind right now is it's really hard to wrap your head around bonds offering negative yields such as in Germany, Japan, and Switzerland, and the willingness of investors to buy them and to lock in negative returns for 10 years. And second, these low or negative international yields are creating significant demand for our higher yielding bonds. And that demand is really acting as a heavy weight on our bond yields moving higher. And I think finally, just how aggressive could our central bank or the Fed be with hiking interest rates in such a low or negative global interest rate environment. So I think that's an important point to just touch on. So with that, we'll go ahead and wrap things up. I think we covered a lot. And again, if anyone would like to discuss anything in greater detail or have any questions, please don't hesitate to reach out to us. Thanks again, and we'll be back to you in early July with our second quarter update.